Hello and welcome to the special segment called MC Pro Select Stock of the Day. In this segment, we bring to you fundamentally strong stock ideas that you can consider in your portfolio. So today's stock of the day is AU Small Finance Bank. If we talk about the company, then it is a Rajasthan-based small finance bank promoted by first-generation entrepreneur Sanjay Agarwal. It started its journey in 1996 with CV financing, converted to a small finance bank in 2017, predominantly into secured lending, got unsecured assets, predominantly microfinance through acquisition of Fincare SFB, applied for a universal banking license. If we talk about the Q3 financial year 2025, it was a quarter of lingering asset quality challenges. If we talk about the growth outlook, then it looks less optimistic. AU's gross loan book grew by 3.7% sequentially year-on-year. Comparison not meaningful due to the consolidated of Fincare's financials from Q1 financial year 2025. If we talk about the growth, then it deaccelerated from the 5.3% growth seen in Q2. Secured business grew by 5.1% quarter-on-quarter, but unsecured degrew. Growth impacted by slowdown in microfinance and calibrated approach in credit card. The growth in the loan book year-to-date has been 12.9%. The bank has scaled down the full-year growth target from 25% to 20%. Deposit market remains competitive. The deposit market continues to remain extremely competitive. AU saw a sequential growth of 2.3% in overall deposit. Term deposit grew, although low-cost current account as well as the savings account showed a sequential decline. If we talk about the total deposits, then it grew 14.9% year-to-date. In fact, your CSA ratio declined to 30.6% in Q3 compared to 32.4% in the preceding quarter. Let's also talk about the interest margin outlook. It looks subdued despite Fincare's high-yielding assets. The addition of high-yielding assets like microfinance and gold had a positive impact on AU's lending yields from Q1 of financial year 2025. Now, the incremental lending yield in Q3 was lower than Q2 as the bank reduced high-yielding unsecured. The cost of the funds rose by 2 basis points sequentially. The bank is guiding to a full-year cost of funds which is at the lower end of the band of 7.1 to 7.15%. Let's also talk about the net interest margin. The net interest margin declined sequentially from 6.1% to 5.9%. Higher proportion of investment book, adverse loan mix in the favor of secured assets, higher cost of funds and interest reversal on NPA led to NIM compression. Asset quality challenges might linger on for few more quarters. If we talk about the slippages, then it remained elevated in the quarter, led primarily by unsecured assets and some seasonal impact from wheels and agriculture commodity related business. Let's also talk about the microfinance. Then it remains a pocket of bother and slippages were higher in Q2 and Q3 and the trend is likely to continue in Q4 as well. If we talk about the annualized credit cost for microfinance year to date, then it has been 5.41%. The full year credit cost on the entire portfolio is expected to be 1.5 to 1.6% of the gross loan portfolio. Now, if we talk about the gross NPA, then it increased to 2.31% and net NPA increased to 0.91% and the provision cover stood at 61%. The bank has managed its cost head well amid the challenges. OPEX asset was at 4.1% in Q3 compared to 4.5% in Q2. Cost to income ratio declined by 300 basis points sequentially to 54% in Q3, aided by lower acquisition in the cards, merger synergies, efficiency, some moderation in overhead cost. In fact, your CI for the full year is expected to be around 58% and would gradually decline towards the bank's target level of 55% in the next few years. Now, the bank would be happy to maintain ROA of around 1.6%. So with that, it's a wrap. For more such updates, keep watching moneycontrol.com and please like, share and subscribe to Money Control's YouTube channel.